Alrighty, so hopefully you have been watching the course in chronological order. And if you have, then you will have just finished the liquidity module within the overall technical analysis module. Now, especially if it's the first time you've gone through that, it can seem a little bit overwhelming. There's sort of a lot of detail and it can seem a little bit complicated, which is absolutely normal. So don't worry. So right now what I'm going to do is basically do a summary of the whole technical analysis module that you've just gone through, but a reasonably basic version of it, just to kind of help get very clear in your mind of what it is we're trying to do. Okay. Before we're then about to jump into the next overall bigger module, where we're really going to look at the entry models and really dive deep into actually how we put it all together, how we put all of those technical concepts you've just learned into a formulated and very, very systematic strategy and trade plan. Okay, but before we dive into that, I just kind of want to do a quick summary lesson to kind of wrap things up. So I'm not going to go into the exact rules of every single thing you've just learned, but kind of just try and simplify it in your mind a bit, because if we can do that and if we can zoom out and kind of look at it from above like a bird's eye view, I think that can really help you to be able to retain the information and understand what it is we are trying to do here. Okay, so essentially the three main parts of the technical analysis module that you've learned is market structure, supply and demand, and liquidity. Okay, so the first thing, whenever you get to your price chart, you should be thinking about and mapping and starting with is market structure, because this gives us our directional bias. Okay, so just imagine that this is your medium time frame. So for me, when I'm day trading, this would be the M15. Perhaps if you're using more of a swing strategy, your medium time frame would be the 1 hour. Okay, so the medium time frame, remember, is that gives us our immediate directional bias for the session. So it's like, this is why it's our main time frame. Okay, the medium time frame is what we focus on, and we're going to talk about this a lot more in the upcoming module. And this is where we focus on our POIs. Okay, but we'll get into that in a bit more depth. So again, first thing we do is we mark on our structure. So if we just work from left to right, we read it like a book, we build the story, we can see that we had a bullish break of structure here, and then we had another break of structure here. So if we just mark on our swing points, right, that's the lowest point that broke the high, we get another swing high here, and then this is the lowest point that went on to break the high, so that's our new low. Okay, so straight away, before we've even done any more complicated analysis, I can now see that we are in a bullish trend on our medium time frame. Okay, don't worry about the three types of structure or anything. We're going to keep this quite simple. Just think of this as the swing trend, right? Swing trend in the medium time frame, we're bullish. So, so now we know that this is the current range we are working within. Okay, so this is super important and really effective, because straight away we just know that this, between these two red lines, is where we want to be looking ideally for a bullish play, right? We want to buy somewhere in here to try and target that next leg to the upside, because what do we expect after a break of structure? We expect a pullback, and then we want to try and capture, ideally, this next pro trend move. Of course, we can play the pullback and all of that complicated stuff, but the general trade we want to capture, right, is that movement here to the upside. So directional bias is bullish on our medium time frame. Nice and simple. Okay, so once we have our directional bias, the next thing we want to be doing is looking for, okay, we're bullish, but where is the area in which we can play that bullish idea? Right, we're not just going to buy straight away. We want to look for where we're going to time that directional bias and time that idea. So this is where we use supply and demand. And of course, we're only going to be looking for demand zones between these two red lines, between our high and low of the current range, right? This is the range we're working within and that we care about. So let's work our way down from the bottom. So there'd probably be like a POI here that's already mitigated, and then we can move along and we can look at this zone here. Okay, and then we've got one more, this zone here. So really, we've only got two demand zones, two POIs that we can look to play our bullish idea from at the moment. So let's start to kind of build a bit of confluence with them. They are both in the swing range. They led to swing break of structure, right? So that makes them valid. If we mark on the premium discount of the range, they're both in the discount, which is decent, right? So again, going to keep going over it, going to keep repeating the basics, but our medium time frame is our most important time frame. This is what gives me my directional bias for the session. This is then the POIs that I'm looking to trade the idea from. Okay, so I cannot take a trade if I'm looking to get long until either of these medium time frame POIs have been mitigated. Okay, so I'm not trading anything in no man's land. I have to wait for a medium time frame POI mitigation before I can then drop down to my lower time frame and then look for the entry model. Okay, so in this sort of simple scenario, I'd literally be setting my alerts on either of these POIs and then looking for price to come in. So we've used market structure to give us our bullish bias. We've then used supply and demand to help us time us playing that directional bias. Okay, it gives us the location of where we're going to look to get involved. And then what you've just gone through in the liquidity module, really it's kind of to help us time those ideas. Okay, because if we don't kind of use liquidity, well, one, you can use it to refine your POIs, the actual POIs you're interested in trading from, which I'll talk about in a minute. And two, you can use it to help time the entry of what you want to see when price gets it. Rather than just jumping in straight away, we can look for our strong liquidations to occur. Okay, so what do I mean by that? Well, let me try and summarize the liquidity module in sort of the most simplest form. So with market structure, well, let me take it even one step back. Everything we're trying to do here with the technical analysis concepts that we use at Photon, in theory, we are trying to identify institutional activity in the market. Okay, I kind of hate the word institutional, but we're basically looking for, where are there big amounts of volume transacting in the market? Where is the big money playing at? And I personally want to be trying to trade in line with that. Surf on the coattails of the big guys, right? It's kind of a phrase that gets thrown around. That's really ultimately what I'm doing with everything here. I'm trying to identify their footprints in the market. Okay, cool. So market structure is the first thing we do because we want to see the overall direction of the market. Where are the big players pushing the market? That's the direction we want to play in. Okay, we get that. Cool. We have our directional bias. Step 2, supply and demand. So when we're looking at these supply and demand zones, why do we do that? Well, it shows us where there was those overwhelming imbalances previously between supply and demand. So i.e., where have those big guys stepped in, right, to take control, to cause that next big bullish move in the market? Here and here, right? We look for those pullbacks, those short pauses in the market before they then lead to those bullish moves, right? Where they break structure and they'll flip, supply and demand. So, i.e., we have this supply zone here, right? This was a valid supply zone that led to the break of that low. Okay, then price came back into that supply zone. It reacted, but that supply, it failed to put in a new low, right? And demand took control. So this demand zone flipped this supply zone, right? Because we came into supply, it failed to break structure, it failed to do its job. Big guys stepped in, if you think about it that way, demand took control and pushed the upside, okay? So supply and demand is where we have looked previously, where we can see that those overwhelming imbalances were caused. So then that helps us to potentially see that when price returns to these areas, if they're in line with our overall directional bias, that can help us time future involvement, right? Whether the institutions have kind of left orders remaining here, or there might be areas where they look to get involved again in the market, right? There's obviously complicated. There's many different ways people are entering here, right? Market orders are there's millions of different reasons of why people are participating around here, but in simple terms, there was previous activity here, so we're looking for activity here to line up again. Okay, so that's supply and demand, showing us the footprints of that institutional involvement. Now, liquidity is that third thing that helps us to, one, identify where institutions potentially got involved previously, and then we also look for our liquidity concept to appear again to help us show where they may be entering in the future. Well, how do we do that? Well, the first thing, let me bring it back one step, was when you were looking here, right? So this is in the inducement lesson, I believe, where basically, why do we use liquidity concepts? How does it help us to show where the big guys are getting involved? Well, bring it back to basics. If a market isn't very liquid, right, and there aren't really any orders at some of the price levels, if you're a big guy and let's say you want to, these are simplified numbers, but you're trying to buy 700,000 worth of volume and there's only 500,000 at that level. So you're buying, what do you need? You need an equal and opposite sell order. Well, if you put 700,000 in long here, yes, you'll get filled some of your order here, but then it's going to have to jump up all the way up here to fill your remaining volume. So what does that mean? It means that if you're a big guy getting involved in the market, you need a lot of opposing liquidity. In more simple terms, if you're buying with a big order, you need a lot of sell orders at your price level to get you filled. Otherwise, you're going to get filled all the way up here and you're going to get slippage. But you don't want to be buying up here. You want to be buying at the best price possible. So if you're a big guy and you're buying, Where do you want to be buying? You want to be buying where there's loads of sell-side liquidity, opposing liquidity. So what do? We assume there is a lot of sell-side liquidity, so a lot of sell orders below structural lows in the market. Okay, and we explain all the reasons as to why there can be sell-side liquidity below lows. But in its most simple terms, if I could again try and simplify it for you, we are looking for where there are structural lows in the market. So the main way I focus on is a low that caused a high, that broke structure. Okay, so this low led to a move that broke structure. Therefore, there's going to be strong liquidity below this low, right? This low here, yeah, there's a structural low, so there'll be some liquidity behind it. But you see how this low, it didn't do what? It didn't lead to a move that broke structure. Therefore, I do not call it a strong low. Therefore, I do not assume that there is strong liquidity behind it. Okay, whereas this low, what did it do? It broke structure. Therefore, there's going to be a lot more induced liquidity in the market, a lot more induced sell-side liquidity. So basically, if we're looking for those strong liquidations, if we're trying to identify another clue of where the big guys might be buying, right? They might be buying below these lows. Why? Because there's going to be sell-side liquidity below these strong lows, these strong pieces of structure, and that is where potentially the big guys might be buying, right? To reduce their slippage. That is the most simple way I can summarize these liquidity concepts, right? So I'm going to bring it back. 3 things we're doing: market structure, showing us the overall direction of the bias. Where are the big guys pushing the market? That's the overall trend, the overall direction of bias. Okay, cool. Supply and demand. Where is the location of those big orders entering the market? So we can time that direction of bias, right? Where is the location we can play that direction of bias? Well, we look for where they previously pushed the market. Where did they previously enter? Here, okay. That gives us an edge of where they may enter again in the future to play that next movement. Okay? Liquidity. We can see where they enter the market, right? But if we know they're going to be using opposing liquidity to enter the market, that's where we can use liquidations to help us time that. It's just another tool of showing us, because sometimes you'll get a demand zone, that forms like this, but they can fail, right? Price can come back down and it just pushes through. So liquidity is another layer we're adding to help us signal that this move here or here was created by an institution, right? So yes, they both led to a break of structure. That is a good sign. But what are some things we can look at to see the difference between these two zones, purely from a liquidity standpoint? Well, this zone down here, what did it do? It took a low when that zone was created, right? So if we draw on this low here, right, we now know that was a sweep zone. Okay, so for sweep zones, we don't need it to be a strong low. Okay, it doesn't need to be a low that broke a high. I mean, it's nice if it is. It doesn't need to be. Okay, we can just see that some liquidity was taken behind that low, so we know there'll be sell side liquidity below here. And then what do we see? The big guys use that sell side liquidity behind that low in order to buy, and they get long. Okay, now sweep zones for me, they're not like a super strong piece of confluence. They're like a nice to have. It's just a nice little extra additional thing to see that, yeah, potentially there was institutional involvement here where they got long using the sell side liquidity below the low. Okay, so it's a nice to have. It's not a a strict criteria. So that's one way in which you learn when we looked at sweep zones, right, of potentially signaling that there was institutional involvement in the creation of this demand zone. Whereas this one, you can see it didn't take any liquidity when it was formed. Okay, now that doesn't mean that we can't trade from here. It's just one less piece of positive confluence to signal institutional involvement. Okay, so sweep zones are like a nice little bonus, but they're not something that I massively pay attention to. Okay, now what I do massively pay attention to is the next bit, and this, as you will see when we look at the entry models, is definitely a strict criteria. This means a lot more to me in terms of importance when we're looking at liquidity. Okay, and that is when you learn this with the POI inducement lesson, the last lesson or towards the end of the liquidity module. Okay, now this looks kind of complicated and it looks like there's a lot to remember. So let me again simplify it for you. We've built our directional bias, we're bullish, we've identified 2 areas, 2 POIs, 2 points of interest, 2 demand zones, right, in which we potentially want to try and time that idea, because these are the only demand zones we have to work with the current price action, right? Okay, cool. This is a sweep zone. This isn't. Okay, whatever. It's a nice to have. It's not, the be all and end all. When it comes to inducement, what we're now looking for is there any available strong liquidity for potential institutions to use to get long in the future. Okay? So what does that mean? It means, is there any strong liquidity in the leg to the left? And is there any strong liquidity built to the right? Because if, excuse me, if institutions are going to be getting long again, all right, we're assuming they're going to be buying here, what are they going to need, right? Yes, some of them maybe just be leaving limit orders in here, and that'll be happening too. But what we have found is we want to see strong available liquidity, sell-side liquidity, for them to buy against. Because if that doesn't form, if there isn't any strong sell-side liquidity here, very often then the POI will fail. And that's what we learned here. Okay, so there's no, again, what is strong liquidity? Strong liquidity is ideally we want to see a low that breaks a high. Okay, you can use big and obvious equals, but I personally prefer to focus on this because this is very mechanical, right? Equals can be a bit subjective, whereas this is a low that broke a high, therefore it's strong structure, and we assume that induces strong sell-side liquidity below the low. So again, let me. I keep on trying to simplify this for you guys as much as possible. If we are looking for strong available liquidity and we're buying, I basically just want to see a low that broke a high. That's how I could summarize almost that entire liquidity module for you. Is I want to see either a low here in the pullback, right, that broke a high like this. Now I know there is strong liquidity behind this low, and that's what I want to see. I want to see it built in the pullback, and now we have that strong liquidation within our POI, and we can assume potentially that there's strong sell-side liquidity below this low, and institutions, big guys, can use that to buy against, right? They can buy against that sell-side liquidity because strong liquidity has been built where? In the pullback. So we have that pullback inducement, PBID. That is what we want to see, okay? So it's either built in the pullback, there is a low that broke a high in the pullback, or where else can it be? It can be in the leg to the left, right? It can be lid. So there's only two places it can be. A strong low built to the right, or there's already a strong low here. So in this scenario, there's no structural low here, is there? So there's nothing here. So if we wanted to trade from here, what would we need to see? We would need to see it built in the pullback. When you see a low that breaks a high, then we look for that to get liquidated. Now, this strong liquidation can happen on your lower time frame, and we'll talk about this a lot more in the upcoming module. What I want you to just focus on now is if there's no liquidity to the left, we need to see it built to the right. Otherwise, we assume this POI is going to fail. And that's literally what this lesson is. If there's nothing to the left, we want to see it built to the right. Otherwise, what happens? Very often the POI will fail because the only available strong liquidity is behind the low. So when this happens, we basically we don't get involved. We just leave it alone. This is when there is strong liquidity to the left, right? There's a low here. This is a low that led to a break of structure. Therefore, we can use that low for this POI, right? We're not going to trade this POI. Why are we not going to trade this first one? Because there's no liquidity here. There's no low. And there's nothing built to the right. There's no strong low here. Therefore, we don't trade this POI. We wait for this one. Okay? Here, this is where there's nothing, there's no lid. There's nothing in the left, right? There's nothing in this leg. This is lid, right? This is the leg to the left. Here, there is no low. So what do we need to do? We need to wait for it built to the right. This is a low that broke a high. Now we have a strong low. We have our strong liquidation. We can look to get involved. Okay? Here, what do we have here? This is where we have both. We have both lid, leg inducement to the left, and we have PBID. We have it built in the pullback. That's an example with kind of equal lows. I personally prefer it when we actually get a break of structure. Again, we'll talk about this in the entry models, but it's just to get the example. There's either nothing to the left, to the right, we don't get involved. There is something to the left, okay, we can get involved once that low gets liquidated because we assume they're using the sell side liquidity there. Or if there isn't anything to the left, then we must wait for it to be built to the right. That strong liquidity built to the right. Or the best is when we have both, right? That's even better in theory. Okay? So, again, to summarize, overall directional bias is bullish. We formulated that with market structure. Happy days, we know we want to get along. Supply and demand, that helps us time the idea. We look for where did previously the big guys potentially enter the market. Okay, we have two POIs. We can use premium discount. There's other confidence factors we can use. But overall, we should be reasonably comfortable with that. Liquidity, timing. Again, sweep zones is a nice thing. It definitely, it's a thing I like to see, but it's not what I'm massively paying attention to. What is strict criteria is now seeing where is the fresh, available, strong liquidity. Okay, where the big guy is going to be looking for, we assume a load of sell orders for them to buy against. Well, the mechanical rule we use is we want to see lows that broke a high, right? And price hasn't traded below it since, so we know that there is available sell-side liquidity for the big guys to buy against. Okay, and it either needs to be here in the leg to the left, the medium time frame leg. It must, right? must be in this leg for there to be lit, or we want to see it built in the pullback, right? And then we can look for that strong liquidation to potentially get involved. So that's really what liquidity comes down to. Where are the available strong liquidity? Either here or here. Otherwise, we don't look to get involved, okay? So if price just comes down like this, right? None of these lows are breaking highs. They're all weak lows. We don't get involved, right? And we just look for price to trade through the POI. If the POI holds and it goes, fine. It's not part of our edge. Sometimes that will happen. But we want to see a strong liquidation built in the pullback. Okay, so then here, maybe we get a low that breaks a high. Then price comes down into our POI. Okay, now what do we have? Now we have our strong liquidation. And this is one of our entry models, right, where we can look to get involved. You will learn this entry model in depth, like I keep saying in the upcoming lesson, but it's just to get you to understand what we're trying to do here. Now we have our strong liquidation in the POI. We can look to get involved. And alternatively, we can use the liquidity from the left as well on this occasion. This is where we have both from the left and the right, but we need to wait for our POI mitigation. Okay, so again, you'll learn this in the upcoming module, so don't worry about the details of it. I just want you to understand the overall arcing idea of what we're trying to do here. Market structure to get our directional bias. The medium time frame is what we focus on. Okay, we're going to talk about the 3 time frames in a bit. We're going to go over this again in the upcoming lesson. Okay, but essentially, yeah, we'll talk about this in the next module, but you focus in your medium time frame, the current range, you know your directional bias is bullish, you identify your POIs, and then once we get our liquidity requirements, that's where we'll take the low time frame entry. Okay, these are the areas we want to get involved in. So liquidity concepts, we either will look for the strong liquidity to the left, we need to see it right, or we need to see it built to the right. If we don't get that, we don't get involved, and that's it. So hopefully now, again, if you've gone through all the lessons in order, there is a lot to learn. There are a lot of variables. It will take time, but I think this is kind of the best way I can try and summarize it for you. You get your medium time frame bias with market structure first. Then you identify any POIs if there are clear ones. Okay. Use the confidence factors that we know. If there's a higher time frame POI nested within it, if it's premium and discount, if it's a sweep zone, right? They're all things that can help to improve the probability. If it's kind of like part of a previous mitigation, we're starting to build that demand chain, etc., etc. Okay, cool. We've got our POIs. Now we wait for our liquidity requirements, right? Either to the left or to the right, and we'll get involved. And that's what you're going to learn in the next module with the entry models. Okay, and we're going to go over, all of this stuff in depth again and again with trade examples, helping to build the narrative. Obviously, market structure can get complicated when we've got multiple time frames and we've got the 3 types of structure. But in a nutshell, this is what we are trying to do. So I'm hopefully this will be really, really helpful and to kind of simplify, especially the liquidity module too. But yeah, come back to this video if you kind of find yourself just getting a bit lost and a bit overwhelmed with it all. I'm really hopeful this kind of help you to zoom out a bit, get that overall bird's eye view of what we're trying to do before you get too lost in the weeds. Okay, cool. Let's dive into the next module and really start to look at these entry models now and put it all together with tons and tons of trading examples.